Hello everyone, great to be with you today, and today we're going to be exploring trading the Eurex gateway to European markets. Exciting things happening in new products that I want to bring you up to date on, and some upcoming events that we're going to take a look at as well. But before we get started with that, I also need to tell you a few things about risk. With any investment, risk is involved, and futures is no different than any other investment. It's important that you understand that what we're going to be looking at today is for educational purposes. There's no trade recommendations. Also, I am not affiliated with and I'm not being endorsed by what I'm going to share with you by Eurex, NinjaTrader, or Dorman Trading. These are ideas that I find helpful and I hope you find helpful too. So that's the intent behind today's program. And with that, I also want to give you a little background about where I come from. And that is, I come from the floors in Chicago. So how I look at the markets, and we're going to see some of that later on when we talk about trading strategies, but it's from a floor perspective. We don't need to be on the floor anymore. Right now, we have the tools available to us, and we see that with NinjaTrader that gives us the ability to gain insights into the market. And we're going to be looking at that a little bit later on. I've also had the opportunity to work on a variety of projects around the globe in terms of even starting exchanges in the Cyprus Stock Exchange with USAID, also testified in federal court. I've had a chance to set up different trading operations in the United States and other parts of the world. I've co-invented a couple issued security patents and a third security patent, which is pending. And I've had a chance through a word-of-mouth network, which totally amazes me, to work with traders from over 36 different exchanges, 450 institutions, and 35 countries. So that's a little bit about my background so you understand where I'm coming from in terms of my thought process. But let's start out by looking at this chart. I know there's a lot of information on here, but trading the Eurex gateway to European equity markets. There are many compelling reasons to consider trading on Eurex, including the unique geographic exposure Eurex products offer for trading and hedging risk in the Eurozone. You might be familiar with several of the most popular European equity index benchmarks, such as the Euro Stoxx 50 and the DAX and the mini DAX 30 index futures. These are indeed some of the most active Eurex equity index products, both in terms of volume and open interest. But today we're going to focus on two of the most rapidly growing Eurex products. And then we'll close with an emphasis on the upcoming French election and a timely potential trading opportunity related to the Eurex VSTOXX Volatility Futures and Options and the Eurex Stocks Europe 600, a broad-based equity index future. If you're not familiar with those products, they're incredibly exciting and incredibly unique. Now, as shown in this table in green, the 2017 average daily volume and open interest have grown strongly in both the VSTOXX and the Stocks Europe 600 based on a variety of recent and anticipated events. The VSTOXX average daily volume has grown over 20% year over year and now sits at over 50,000 contracts per day. Open interest has jumped from 220,000 to over 370,000 contracts year over year. The Stocks Europe 600, the average daily volume sits at a healthy 50,000 contracts per day, with open interest rising over 20% to nearly 300,000 contracts. So the question is, why have we seen these Eurex products grow so rapidly since last year? Well, here's the answer. Volatility and global uncertainty fueled by the Brexit and the U.S. elections have created increased interest in similar events, well, namely the French elections in April and May and the German elections later on in September. Opportunities abound for participants to take direct advantage of European market movement. with the Eurex products. Eurex really does offer the gateway to Europe. Let's move over to this next slide and see what that's telling us about what's happening in this marketplace. And as you can see, with the increasing volume and open interest on this chart, trading broad-based Europe with the stocks Europe 600 is clearly in the spotlight, and it's increasing. As interest surrounding fundamental events in Europe increases, so does participation in this broad-based hedging tool viewed as the benchmark for the entire European stock market. Comparing the stocks Europe 600 as the S&P 500 of Europe really is an accurate point of view. One of the interesting observations is that we see significant volume increases in off-exchange or OTC activity around the traditional, excuse me, March, June, SEP, and DECE expirations. Now, this increased activity that you see here and the fact that open interest is seen rising in tandem, it validates the fact that traders and investors are holding and rolling large stocks Europe 600 positions as a part of medium and longer term plays on the European markets. So why look at the stocks Europe 600? In the United States, market participants are only beginning to absorb the implications of Donald Trump's young presidency, and we've all seen the impact this has had on global equity markets. In Europe, the upcoming elections in France and Germany threaten to upset the status quo across Europe. Consequently, market participants welcome an index with broad pan-European representation of the stocks Europe 600 index. This alone is a compelling reason to keep the stocks Europe 600 on your radar. But it's also Europe's leading broad-based benchmark and a unique barometer for overall European market sentiment and subsequent sectors. With the fixed number of 600 components, the Stocks Europe 600 index represents large, mid, and small capitalization companies across 18 countries of the European region. And here's what fascinates me. It's capturing 90% of the European country-specific activity. We don't have an index that I'm aware of any place in the world that captures that much capitalization with one index. I just think that's fascinating. So when you really think about it, it's no surprise that this Stocks Europe 600 saw significant market movement during recent political events based on the variety of countries represented by this product and their respective percent contributions to the overall index price. Now listen to this. The UK, if you look at that chart there, the UK represents approximately 30% of the Stocks Europe 600. So when we saw, it wouldn't be surprising, but we saw significant movement following the Brexit vote last year. Along the same lines, over 79 of the 600 Stocks Europe 600 components, about 15%, are French. So this index is comprised of such names as Christian Dior, L'Oreal, Peugeot, Vivendi, and then also important financial companies like AXA, BNP, Credit Agricole, SocGen, just to name a few of the 79 French companies that make up the index. So there's a lot of interest in the upcoming French elections with the expectations that this index will likely again move in reaction to the French election results. Now we have attached at the end of this presentation a link highlighting the French components of the Stocks Europe 600 to give you that reference. But looking at this chart, there's something else I want to point out to you, and that's just take a quick look at Nikkei 225. Let me grab my cursor here so we can do that. There we go. Nikkei 225 represents it, it is the reference index when you think about Japan. Well, that represents 60% of their market cap. And if you look at the S&P 500, that's the largest, most referenced stock index actually that we have in the United States. Well, that represents 75% of the total U.S. market cap. And then you have over here with the euro, with the stocks Europe 600, 90% of the market cap. How could you and I reproduce that? You'd have to go around all these countries, set up a stock account if you wanted to do that. It would be expensive, it'd be tricky, the timing would be an issue, and here, you and I get to do it with just one transaction. We can gain that exposure. Very interesting, isn't it? Well, many of you are familiar with one or more of the common tools used for trading volatility in the United States, and that's the VIX. A lot of people hear about that reference tool or look at it. Well, for years, market participants have been using the VIX as a proxy for trading any type of global volatility. And, what we've seen is, as demonstrated by the moves we've seen, for example, in Europe just last year, European markets have unique reactions to these monumental events taking place in the region. So smart market participants are using the appropriate tool for trading and hedging equity market risk in Europe, and the Eurexes with actually using the Eurex V-Stocks volatility futures and options. So the V-Stocks is Europe's volatility benchmark. It's designed to reflect investor sentiment and economic uncertainty by measuring the 30-day implied volatility of the Euro Stoxx 50. Now recall that volatility indexes have a negative correlation with equity markets, and they often serve as a leading indicator of movements in the underlying equity market. So when one rises, the other typically falls. The Eurex V-Stocks futures and options have monthly expirations, and they reach 8 months into the future. It's no surprise, that we've been seeing some large positioning, record open interest, and dramatic rise in the volumes in the two monthly volatility futures and options expirations straddling this upcoming French election, April 2017 and May 2017 expirations. Now, we have explored why it's vital to monitor stocks Europe 600 into the French elections, but these V-stock volatility products are equally important. With 18 of the 50 V-stocks component coming from France, this volatility measure is currently weighted at over 34% French. So again, eyes are going to be upon it. And we're going to see this market reacting to these upcoming events. So looking at the composition of the V-stocks, it's clear why there's such a high level of interest in the Eurex V-stocks complex. And again, there's a link at the end that'll show you the V-stocks components if you want to look at that in more detail. So why look at the V-stocks volatility measure? Well, since VSTOXX reflects the European specific market sentiment and the European macroeconomic environment, it is the most appropriate tool to hedge outright exposure to the EU equity markets. For instance, looking at the top of this chart, the inverse correlation between the VSTOXX, now that's the green line, and the European benchmark equity indexes, the blue lines, increased throughout recent political periods. Now looking at the bottom of the chart, while European V-stocks and the US VIX are similar index calculations, there are some stark differences between the US and the European volatility measures. The V-stocks index is fundamentally valued at a premium to the VIX because the V-stocks is more concentrated. The V stocks is based on the Euro Stocks 50, an index of 50 stocks, as compared to the VIX and the S&P 500, which is an index, as you know, of 500 stocks. Plus, these stocks components are often more volatile, since approximately 25% of the V stocks and the Euro Stocks 50 components are financial, as compared to 17.5% or so in the VIX and the S&P 500. Now, the V stocks VIX spread is volatile and mean reverting. But it breaks down, especially during times of European and U.S. specific crisis. Since January of 2014, this spread has averaged 5.47 points. Now, we're talking about the V stocks over the VIX, so your long V stock, short VIX. In the Greek crisis in June of 2015, remember that one? The spread went to 13 due to the Greek crisis. And then it went down to 1 in August of 2015 when the U.S. equities tumbled. In June of this last year, June of 2016, the spread went over 20 due to the Brexit and continues to react dramatically to the EU-specific volatility events. So there's a lot of anticipation to reaction in these upcoming elections. And listen to this one. For those of you in the United States, VSTOX options are now available for trading in the U.S. And there's new ETNs, and those are exchange traded notes on the VSTOX, and they're also going to be launched. So we have another product that you and I can look at. So if you're looking at relationships between the European equity markets and the European volatility, you should have the Eurex VSTOX volatility product on your radar, as surging volatility in the run-up to the French election has ignited considerable interest. And we're going to see it after that as well. So using proper hedging vehicle is critical in order to capitalize on macro divergences between the Europe and U.S. Now, this is another section where we're going to be talking about this upcoming French election. We have some background on two very important European-focused Eurex equity index products. So let's take a look at some possible market opportunity. And if you're not familiar with the first round of this upcoming French presidential election, it's going to be held on Sunday, the 23rd of April. And should no candidate win a 50% majority, and right now there's 4 people that seems to be leading the pack. 2 of those people are the EU, and 2 of them are saying we should get out. So we're going to see that type of run-up. So the probability of somebody getting more than 50%, not likely. And so that means there will be a second runoff election between the top 2 candidates who received the most votes, and that will be held 2 weeks later, which would be the 7th of May. But regardless of which candidate or candidates make it through to the subsequent rounds, let's look at some possible clues to market action that you and I can use, not only for this election, but as the year goes on and we look at these products. What I'd like to start here with is a tool that probably many of you are familiar with. It's what I call behavioral Japanese candles, and I imagine many of you are familiar with Japanese candlestick charts. This is a tool that I saw in Tokyo, actually back in the mid-'80s. I was teaching a course for Bank of America for customers of the bank, actually, Sumitomo Bank, Daiichi Bank, and so on. And they were yield curve traders. So part of the class, we went into the trading room, and I would identify some trades in the 30-year treasury bonds. So we put those trades on. And as I'm walking out, I see a fellow sitting at a desk about 8 feet by 4 feet, a large desk, and he had this huge piece of paper. And on the top, he was drawing daily, and on the bottom, he was drawing weekly candle charts of the 30-year treasuries. So I see this, and I said to the fellow I was with, I said, Kuno-san, what are these? And he said, oh, these are Japanese candle charts. Now, and they were kind enough to talk to me about that. But what went through my mind is what I want to share with you. Because what went through my mind is, what does this represent? What is the behavior that we see that forms this? Now those observations take me back to the floor. Because by observing the broker's hands, and it took me a while to really pick up on this actually, but by observing the broker's hands, we had an idea of what was happening in terms of order flow coming into the market. And on the other side of that order flow, typically you have a market maker. And that market maker's in and out in a second. They'll sell when you want to buy and they'll buy when you want to sell. They're trying to take the difference between the bid and offer. Those people, they don't cause a trend. The order flow that comes into that market, who still have a position, that order flow, that causes a trend. And I believe that you and I can see that bias. Now, I want the people who are not familiar with candle charts to understand that what I'm going to say here is, it's my observations. It's not a standard approach to candles. That would be the discussion of about 80 different candle patterns. But you know what I find with that is that by the time you get to number 80, who remembers number 1 pattern? And the issue isn't so much the patterns, I believe. I think you can melt those down to about 8 concepts actually, but it's what they represent. And by the end of today, I want to give you a feel, and hopefully you can use what that means behaviorally. So we're going to be looking at the footprints of buying and selling action that come into a market. So, and what they do is they draw a box. And if the closing price is above the opening price, in this case I have the box as green. It's called the body of the candle, but I think it represents buyers coming into the market. Now the reason I say it represents buyers is that it's competition between buyers that creates movement. If the market is opening at, let's say, at 50, and you're a broker and I'm a broker and we still had a floor, and I'm trying to buy 100 contracts at 50 and you're trying to buy 100 contracts at 50 and I bid 51, I get filled, you bid 52, you get filled. So it's competition between us that causes that price to move. It's an auction. That kind of movement is what you and I are familiar with. Only in the market, we have a dual auction. So we ended up closing at 60. Why did we close at 60? Because more people wanted to buy this market than sell it. I mean, during this period that this candle was created, it probably moved up and down as we'd find some buying and selling that came in and out of the market. But that's why I think that represents buying. Just the opposite on the other side. When the closing price is below the opening price, well, I think that represents sellers coming into the market. Now here, I have the high and the low matching the top and bottom of the bodies of these candles. And as many of you know, that doesn't always happen. So here, if we see the high price higher than the body of the candle, that's represented by that vertical line called a shadow. And I think at higher prices, that shadow represents selling. And at lower prices, that vertical line represents buying. Now here's what I want you to think about. The size of the body represents market acceptance. It represents enthusiasm. It represents momentum. So if bodies are getting smaller, it implies a loss of momentum. Shadows represent rejection. It represents the market getting high enough or low enough to find the opposite form of behavior. So for example, let's go and take a look at this green candle. Now, when price traded at the high price, and sometime during the life of that candle, it did. And when it did, that green candle extended itself all the way up to the high. And at that price level, something changed. And what we would see would be brokers' hands flipping over as they're now finding selling orders at that price level. And the market now starts to sell off. And what we're seeing here with that candle shadow are the footprints of sellers coming into the market. So with those ideas, let's take a look at a few of these markets. Now on the left, I have two charts here. They're weekly charts, and on the left, I have the Stocks Europe 600. And on the right, I have the VSTOXX weekly. Now, as you look at those candle charts, there's a few observations I'd like you to make with me. First, the general direction. And we can see here that the Euro Stoxx 600 weekly, pretty volatile, isn't it? Had some pretty big moves, and but it basically ended up going sideways. And if we look at this move, by the way, that big volatile move, that occurred earlier in 2015, 2016. So we had dramatic movements there. And like we were talking about, a volatility index moves in the opposite direction. Well, take a peek over here at the VSTOXX. We see the VSTOXX was making new highs as this market, the Stocks Europe 600, was making lows. So they indeed are that mirror image of each other, basically, right? But there's something else that you and I want to look at, and that is what I call the speed of the market. In other words, if we look at this market here, the Euro Stoxx 50, starting last year, late last year, we saw a big rally, and then we see this market moving up. And it's moving up here at about, maybe a 60 degree, or actually about 45 degrees, which implies a strong market and theoretically very sustainable. But let's take a look at the VSTOXX weekly. What we see here after the end of the year, we had a sideways market, and over the last few weeks, we've broken to the downside. Again, a mirror image of what we have there. But the rate of change, the speed of change, is not the same. Now, first thing that goes through my mind is, this could be a good example of a spread opportunity. So we have two related markets, right? And if we think about what you and I want to do in a spread, we want to buy strength and we want to sell weakness. Well, if we look at the way that this Stocks Europe 600 has moved, that's strength. That's been moving up. And we take a peek down here at the VSTOXX weekly, that's been weakness. So what we could do is we could look at that comparison between these two markets. And we're going to come back to the candle charts actually in a little bit, but I want to show you some characteristics that this represents. So think about these two charts, and let's just summarize that by looking at a spread. So that means this, if you look at a spread, whenever you look at a spread, you have two variables, right? You have one variable minus another variable. The first variable, you're going to be long. The second variable, you're going to be short. So here, we're looking at being long strength, which is the Stocks Europe 600, and we're looking at being short weakness, which is the VSTOXX weekly that we looked at just a minute ago. So what do we see here? We can see since last December, actually since the election last year, presidential election, we can see that that spread is actually getting wider. In other words, it's getting larger. So it implies that the difference that we're looking at is increasing overall for the last few months. So a spread chart is a way to get a feel for how a market's unfolding, especially when you have two markets that march to a similar beat of the drum in terms of rhythm, but not all the time, in a way that you and I can see where there's a dissimilar movement is by looking at a spread chart. And it also may be a trading opportunity that you and I might want to consider as well, too. Now, the next chart we're going to look at is a chart of the Stocks Europe 600. And we're looking at a 15-minute chart, and we're looking at a 7-period moving average. Now, there's a few things I want to point out to you when you look at this market. I think there's some critical issues and critical references that we have that can pop up. Let's start with those candle concepts that we talked about previously. And one of the things we said was that when we have a large shadow on the highs, it would imply selling coming into the market. Now, if you look over here to the left side of that chart, we see that large shadow. And so it means, if we think about what it represents, it means during its life, it traded at the high. And when it did, that would have been a green candle. But something changed. It got high enough to find sellers. Now, the other thing I want to mention to you, with any technical approach, not just candles or moving averages or oscillators, whatever technical approach you're using, whenever you have a buy and or sell signal, typically the next 2 to 5 periods of time will give you clues about the quality of your trade. Now, one of the things we want to look at when we look at a trade is what's the environment that I'm trading in, and also what time of day, but we'll talk more about that. Here, you and I see this larger green candle. See that guy? That occurred before that big rejection candles. That's what I call that. And what does that mean? Well, it means that this market we found buyers, the buyers continued, and then we found some selling coming into that market. Now that large green candle, I call a benchmark candle. It is the last move that we've had with the greatest volatility. In this case, it happens to be to the buy side. There are two levels that you look for in a benchmark candle. The midpoint of how the market trades through that midpoint, and then also how it behaves at the midpoint and how it behaves at the low. Does it trade through it? Does it close below it? Does it bounce off of it? And what we can see here is if I was a seller of a new low of that rejection candle, I sold it a couple of ticks lower right here. Well, it's at the midpoint of that benchmark candle. And if you look at the next 2 to 5 periods, well, just the very next 2 periods, this market's not moving lower. And if I recognize that during this time of day, maybe that this market has a tendency to go sideways, well, then this is typical behavior, and maybe my sell was not really well timed in that regard. But the fact is, with this position, I probably would lose money. I have to tell you, I would sell this if it was the right time of day in terms of price behavior. I would be happy to sell that. And it didn't work. So the issue is, at what point do you and I have failure? And that's something you'd have to determine as you do some research with this concept. But if I sold it 2 ticks below and now it's trading back in my face, 3 or 4 ticks above that level, that may be a time for me to consider this market is not performing for me. All right, so the market grinds along, and now we see another huge, big rejection shadow. Holy Toledo, we got the same thing again. Now remember, when it traded at the high, that was a big green candle, and it failed. So that may be a clue that you and I can take advantage of this movement. Same thing that we had before. And if we look at that action that we're seeing here, and if I would sell it below that low, what do we see here? Well, we see some fairly dramatic movements. In the next 2 to 5 periods, do I get paid for that trade? Yes, it does cooperate. It does move lower. And look at the way it finished. This is another one of those rejection patterns. Remember when it traded at the low, a big red candle, but at that price level, for whatever reason, we found buyers coming back in, just like we did before. And if I buy a new high here, which means I would be exiting my short position, and I'd be buying a new position, a new high here, the same thing applies. The next 2 to 5 periods, they're important to me. And in this case, the market does cooperate and it does start to move higher. It breaks right here. This is what I call a false sense of security. And again, as we make new highs on selling. So the same behavior that we're looking at. starts again. The next 2 to 5 periods are important for us. We did break lower. We started to pull back, and then we gave it another leg to the downside. So the same process would come into play. And what's critical for all of these is before we would ever do these trades, we would have established our risk management, how much risk we're going to take, expected behavior. In other words, when this market moves in a positive direction for our trade, how far does it typically move? How many ticks can we look for in that movement? Now, there's something else up. And by the way, you see a few others. Here's a rejection pattern here. And we also see one at that high, a rejection pattern, again, looking at the next 2 to 5 periods of time. And that's the other thing I want to talk to you about. I believe in the Eurex products, and especially this guy right here, the Stocks Europe 600. There are time periods during the day that are important references for you and me. And, I've dealt a lot and do deal a lot with European institutions. And, I see their behavior in what we're looking at here. So here are the 3 time periods I'd like to mention to you. First, the very beginning of the day. Now I'm again using a 15-minute chart, but this first 15 minutes has a tendency, or some markets the first half hour, has a tendency to be the low or the high for the trading session, probably about 70% of the time. So once we have a tendency to move away from that, we have a tendency to continue in that direction. That's one. The second thing, around 7 o'clock in the morning, 7 o'clock to 7:30. By the way, I'm talking about Chicago times. So 1 o'clock in the morning is when our friends in Europe start trading. 1 o'clock in the morning Chicago time, 8 o'clock there in Germany, for example. So at 7 o'clock, 7:30, that's another important time for these products. So you want to pay attention to that. And the reason it is because it's when our currency and metals markets and fixed income markets, cash markets kick in the US time zone. The next time period you want to pay attention to is 8:30 in the morning Chicago time, because that is when our stock market opens. And this movement that you're seeing right here in that market, that's our stock market that's creating that movement. That's 7:30. No, I take that back. That's actually, I just wanted to see the bottom of the chart. That's 7:30. So it's right after that those markets opened that we see this behavior. And when it breaks here to the downside, the way it finishes is also at that toward the end of that morning session. It's also when the stock market opened. Because you're looking at 9:45 here, and this would coincide with our stock market opening. So it's important to look at those time periods, the beginning of the day, around 7 o'clock in the morning. By the way, at 5 o'clock you can get some volatility in Europe too, so you want to be sensitive to that. And then at 8:30 in the morning, Chicago time. Now let's talk about those French elections. It's going to happen on Sunday. All right, so they may not have all the results by the end of the day. They may bleed over on Monday when people can start expressing their opinion about what happened with the French elections. And if they don't have it at the beginning of the day on Monday, well, by the time the U.S. time zone starts to trade, they probably are going to start getting some results because it's towards the end of their day on Monday. And again, we'll see the market react and absorb to that. So these clues that you and I are talking about, these are ideas that we can use around an event. Would be that, that type of market behavior. There's also just one other characteristic I want to mention to you, and is that before you hit another strong reference, for example, before the interest rates start to trade in the U.S., you'll see some small candles. See those little guys right there? If you can see those little small ones, that is typical behavior. And what happens there is that institutions in Europe, banks in Europe, will even up their positions as they get ready for the U.S. time zone to start trading. It's something I've discussed with many banks there, and it's something many of those banks do. So that's something else to keep in mind. Now let's add this third variable in here, and that is this moving average. Now we have a 7-period simple moving average. And I wanted to talk about some concepts, simple ideas that maybe this may help us with. Well, first, when it comes to a moving average, since it is an average price, it has some challenges also. I mean, it does a great job when the market trends. You can see here it trended, and that means if you and I were long, we'd be long. When it trended down, it may have given us an opportunity to the short side, and here to the upside, and here to the downside again. It may have kept us in part of that trend. But we also want to look at this area where you see a tight sideways market. You see shadows on both sides of this. And again, this could be a time period where you and I say, I don't trade that time period because we have a tendency to go sideways. So you may have filtered this out just by the time of day. And you and I should know when a market's volatile and when it's not volatile. Whether you're looking at an intraday chart like this or daily, weekly, or monthly. Now, what we could also do is do a magnitude objective with this moving average. So let's talk about what I mean about that. And that is this. We could take one, not just to close above this moving average. Oh, let me say one more thing too, in case you're not familiar with moving averages. It's a 7-period simple moving average. So here's what the computer does for us, what NinjaTrader does for us. It takes the closing prices for the last 7 periods. What the computer does is it says a software. It says 1, 2, 3, 4, 5, 6, 7. It takes those closing prices, it divides by 7, and it gives us that point on the chart. So that's how it's calculated. Now let's go back to this trade entry idea. We could say that not only does it have to close above this, but it has to close above by a certain magnitude before we initiate the trade. So let's say, for example, and we want to do some homework with this idea to see how valid it would be. But let's say we use 5 periods. We'd say it's got to be above this 7-period moving average, and it's got to be at least 5 ticks. I said periods, I meant 5 ticks. Well, right here, we'd be initiating a long position. All right, so it did trade below, but it didn't move lower by 5 ticks. Didn't move lower by 5 ticks there. Here it did move lower by 5 ticks, and that means I now would exit that position. And so it allowed us to capture a little bit of opportunity here with this market. It kept us in that movement. And again, we could ask ourselves, what time of day do we see the best moving average trades? Is there a time of day when we see that? And as this market breaks lower, one of the deficiencies of a moving average is with very strong, fast price movement. So if you look at price here, it fell out of bed, right? Moved vertically. It wasn't grinding its way higher like we see here, about 45 degrees. This went basically almost 90 degrees. And the result is that we see a market that went vertical and it really extended itself away from that moving average. So as this market now starts moving up 5 ticks above, you and I are looking to be a buyer. And also at the same time, we have to agree on how many ticks below would we exit that position? What risk is acceptable to us? So we'd know that before we get started here. But in this case, it really didn't trade back below much at all. But anyways, it's moving higher. Right here, it did trade more than 5 ticks down. We would have been stopped out right here at that point. And if we would initiated a sell, that sell failed. It did trade lower, but notice where it closed. It closed right back up above the moving average. We didn't see consistency in our favor. We would exit that position and we have a loss. See, for you and I, the issue is not the loss. The issue is how big is the loss and what's acceptable to our trade, to our account. That's the critical piece. I mean, are you and I going to have losing trades? Sure. It's part of this business. Tell me any business that you could be in where you don't have a losing business decision, whether it's owning a restaurant or running a steel plant or whatever it may be. All managers are managers of information flow, and so are you and I as a trader. We're managing information flows. If I stayed in this trade, after it traded against me, I'm now in a hope trade. Fact is, it failed. And now if we look at this market, we may not have captured any of this movement, which is fine. We don't have to capture every tick on a chart, but here we do see that rejection. And if it trades below by 5 ticks, okay, we can sell that. Maybe we're selling it right about here. And the market did move lower, but there's something I have to point out to you. Whenever you're evaluating a strategy, I call this heat. Did the market ever trade against you? And in this case, it did trade against us. I had to sit through that amount of adverse price movement before it did start to cooperate. And again, I would want to evaluate that. Is that risk acceptable? How much risk do I take to maintain this position? And we can see that, if this was less than 5 ticks, we'd still be in this trade. And maybe we would have exited, for using 5 ticks, we would have been exiting over here. So just some ideas that you want to think about when you're looking at a chart like this. Now I have a couple more I'd like to show you, and the same principles apply. This is, again, our friend here, the Stocks Europe 600. What's interesting about it, it's the rhythm that you see here. I wanted to show you this. Again, it's a 15-minute chart, 7-period simple moving average. But you're seeing a very orderly market. And that's not unusual behavior in this market. Oftentimes where you see a trend, that would be typical. If you look at the overall angle of this movement that you see here, it's about 45 degrees. And that's typically a very sustainable momentum kind of move that you look for. And again, we could be looking at the same principles that we talked about. We could be looking for rejection patterns. We could be looking for the time of day when we see movements. Are these breaks that you're seeing here occurring about the same time of day? So does the European session get stronger, but it's been weaker in the US session? Is that the rhythm that you and I are seeing? I mean, those are all things that you and I could check out. If we're looking at 4 ticks or 5 ticks, whatever we decide below that moving average, that would have created a buy here. We'd be selling it over here. That may have captured a little bit of opportunity for us. If we would have been a seller here and we're buying it back 5 ticks above there, again, we're not seeing it trading below the moving average there. And on the break, we're not seeing it closing 5 ticks above until we get down to here. So that's where that moving average, when you have this type of market, may be a helpful reference for us to consider. Now, this is the VStoxx volatility future. Now, because of the way it trades, because of its volatility characteristics, I'm using a 120-minute chart, so a 2-hour chart. And also, I'm using a 10-period moving average. By the way, if you're not familiar with these moving averages, as with all mathematical approaches, the number of periods of time that you select determines the sensitivity of how that technical approach will move with regard to price. So if I made this 7 periods, it would shift the moving average to the left. It starts hugging price closer because it becomes more sensitive to price change. If I had to make this 20 periods, this moving average line would shift to the right. All right, well, I could look at the same concepts that we talked about before. We could determine the number of ticks that we could use for price entry. We could also determine the number of ticks above that moving average to determine our exit point. And we'd also have to determine the amount of risk that this trade requires using this technique and what is acceptable to our account. Maybe the approach that you and I are talking about here, the amount of risks that we have to take is just not acceptable. No problem. We'll find another way, another technique that will make it acceptable, or we don't trade that market possibly during certain periods of time. Uh, again, knowing when not to trade is just as important as knowing when to trade. So when you look at these markets, and I hope you do, because there are some opportunities here, I think, take your time. Look at it for a while. See how the market behaves and when it behaves. How does it move? And that's what we're looking at here. We could look again, what time of day do we see that kind of movement? We'd be a buyer if the market moved 5 ticks above, if we were using that as a criteria. Here, we'd exit that short, look on the long side. And this trade, now, what you want to ask yourself, after we got into this trade, was it ever profitable? Well, the fact is it did move in our favor. So what you want to look at on trades that do not work, trades that fail, you want to ask yourself, does it ever work? And if it did, by how much? Because maybe you take a few ticks out of that every time you put the trade on and then move your stop up to break even. So if this was, we got in at 50 and it moved, let's say 6 ticks typically in our favor before it failed, well, then at 5 ticks, maybe you and I take half off. We move our stop up to 50, and we'll get out with the moving average or a stop if the market trades against us. So just some things to keep in mind as you look at these markets that I think, again, it's the way I would approach it. Doesn't mean that's the right way, but hopefully it gives you some ideas to think about. Now, I have to tell you something. And you're already sensitive to this because you're here. And by the way, attending this kind of webinar, it really says a lot about you. If you're not trading these markets, it means that you're open to new ideas. You're willing to take your valuable time and to explore it because you're open to the idea there may be other opportunities out there that you want to take advantage of. So just looking at this says a lot about you. And the other thing I want to mention to you, you definitely want to take advantage of these resources that you see here. Eurex, EurexChange.com. The contact, Tim Lewandowski. He is a wonderful source of information for you. Either email him or actually just give him a call. He has a whole variety of sources of information for you. These components that we're looking at here, you're not going to be able to click on these, I don't think, but it does give you an idea of what's available. So please take advantage of that. I know Tim would like to hear from you if you have any questions. And also, let's talk about NinjaTrader. NinjaTrader.com. Take advantage of all the sources of resources they offer. I mean, you're probably already aware of this, but if you're not, free to use software for advanced charting and back testing and simulation. So you could take the ideas that you and I have been talking about and see if indeed it is something you want to look at further by using the software that NinjaTrader provides. Award-winning support. They're there for you. Free data, daily training, and thousands of apps and add-ons. Holy Toledo, what more could you ask for? I have to tell you, on a personal side, what's healthy about that, and it takes a tremendous amount of work to put this together, by the way, what NinjaTrader has done, all the software and things. But it allows you to tailor the services that you're looking for to the products that they have. In other words, they have so many products that is probably going to fit what you're looking for. And that's important. It gives you an idea to explore the services they offer that's going to help you in making more informed business decisions or trading decisions. Also, dormant trading. NinjaTrader clears through dormant trading, and it's one of the oldest family-operated FCMs in the world. So there's a good foundation to this organization, and that's also, as we both know, very important. So tremendous resources here that I hope you take advantage of. And I want to thank you for sharing part of your day with me today. I hope that you gain some insights into these markets and maybe some ways that we can trade this, not only for this upcoming French election, but in the future as well. Also, I want to thank Eurex, NinjaTrader, and Dorman Trading for making this possible, for making the opportunity available for you and I to explore these markets.